We are jumping straight into Chevron today.
hmm
And for so many people, the story just, it stops at the daily price of oil. They see the commodity markets, they see the stock move up or down, and they figure that's the whole story.
Right.
But if you stop there, you are missing the most critical factor, the real catalyst driving this company's valuation right now.
That's absolutely right. The core narrative here isn't about, tomorrow's spot price. It's about a massive internally projected financial shift, a real inflection point that's set to hit in 2026.
Okay.
We've really gone deep into the financial reports, the market analysis to see exactly where Chevron is creating this projected, what is it, a $12.5 billion boost, and why their asset base is proving so resilient compared to their peers.
So our mission today is really to cut through all that noise and give you a shortcut to understanding the key drivers for Chevron's growth over the next few years. And why should this matter to you? Well, because the cash flow that's being generated by this structural change is designed to aggressively return capital directly to shareholders. We're talking buybacks and a growing dividend.
It's a total return story, really,
Yeah,
built on tangible operational expansion.
exactly.
So to unpack this, I think we need to focus on three distinct areas. First, the fundamental strengths that are underpinning that huge cash surge. Then, the unique competitive moat and the geopolitical optionality they have in places like Venezuela and Guyana.
Okay.
And then finally, we should touch on the immediate technical setup that traders are watching today.
Okay, let's do it. Let's unpack this headline figure that's really anchoring the whole long-term thesis. Chevron is projecting a massive $12.5 billion uplift in annual free cash flow
FCF.
by 2026 compared to just 2023 levels. I mean, that's not just big, that is a major internal liquidity event.
It is.
Yeah.
And what's most fascinating is that this isn't based on hoping oil prices spike. It's not a bet on the market. Management is building this growth assumption on operational execution, on scheduled projects finally coming online. We can actually break that $12.5 billion surge into three main engines.
All right, let's get into the first engine then, the backbone of their domestic output.
That's the high-volume engine. That is the Permian Basin,
The big one.
the big one. And it's the ultimate short-cycle asset, which means they can turn the production dials up or down really quickly, depending on market demand.
So they have flexibility.
Total flexibility. Permian volumes are targeted to exceed 1 million barrels of oil equivalent per day very soon. And long-term, they're looking at goals over 2 million BOD. This is high-margin, relatively low-risk domestic production.
So that's the speed and the flexibility component, but they also have these huge traditional projects that are finally delivering returns. That's engine number 2.
That's engine 2, the major project ramp-up. We're talking about colossal, multi-year, multi-billion-dollar investments that are finally reaching peak capacity.
And what's the most notable one?
That would be the Tengiz Future Growth Project in Kazakhstan. Just a massive endeavor that's required years and years of investment and is now finally turning from a cost center into a major cash generator by 2026.
Oh, okay.
And that, alongside key Gulf of Mexico developments, is set to hit its stride right at that inflection point.
And the third engine relies on consolidation, right? I'm talking about the recent acquisition of Hess.
Yes,
Yeah.
exactly. The integration of Hess isn't just about buying volume, it's about consolidating Tier 1 assets. And we should probably pause and define what that actually means.
Yeah, good idea.
So Tier 1 means they are incredibly low cost to extract oil from, and they have very, very long reserve lives,
Yeah.
often measured in decades.
And where is that value concentrated?
It's primarily in the Stabroek Block off the coast of Guyana. I mean, this is one of the most exciting new oil frontiers globally. It offers low-cost production that's highly insulated from, geopolitical instability you see in other regions.
And how much does that add?
This acquisition is expected to add roughly $2.5 billion of that $12.5 billion incremental FCF. So it provides a durable, long-life asset base that significantly lowers the company's overall cost structure.
So it's a mix of shale speed, deep water scale, and major project maturity. But I noticed something else in the analysis that seems really critical to the margin. This isn't just about volume, it's about efficiency and cutting costs.
Absolutely. The structural improvement is key here. Management is targeting a substantial, permanent structural cost reduction of $3 to $4 billion by 2026.
And these aren't temporary cuts.
No, not at all. Think about that. These are permanent efficiency gains. From integrating operations, from optimizing supply chains, this mechanically expands profit margins across the whole portfolio, even if commodity prices stay completely flat.
Which sort of decouples their profit growth from just the daily price swings.
It does. It gives them a buffer.
That level of cost discipline and guaranteed FCF is impressive, but let's connect the dots. What does this $12.5 billion in new cash actually mean for you, the shareholder?
Well, if we connect this new FCF to the bigger picture, it fully supports their aggressive capital return strategy. They are targeting $10 to $20 billion in annual share buybacks.
10 to 20 billion.
Yeah. At the high end of that, that equates to retiring 6% of the company's outstanding shares every single year. That's a huge boost to earnings per share.
And of course, the dividend is legendary in this space.
It is.
Yeah.
This FCF framework underpins their very resilient 4.5% dividend yield, which, by the way, has been raised for 38 straight years.
38 years.
That is a track record that just screams capital stability.
That stability is critical. But how safe are those returns? What if we hit a major global recession and the price of oil just tanks?
They maintain extreme capital discipline specifically for that risk. Annual capital expenditures, so the money they spend on drilling and new projects, is firmly capped at $18 to $21 billion all the way through 2030.
Wow.
This commitment ensures the company can cover its dividend, its core operating needs, even if Brent crude falls below $50 a barrel. That $50 floor is the ultimate resilience check in this volatile sector.
It's incredible to think that a company this big can insulate itself so well from volatility. I mean, a lesson many of their smaller peers learned the hard way back in 2020.
They certainly did.
Okay, so that anchors the fundamental foundation. Let's move into the competitive mode. What makes Chevron fundamentally different from rivals like ExxonMobil? I mean, everyone claims to have a great Permian plan.
Right, and they do, but Chevron's defensible position, it rests on superior asset quality and strategic integration across three pillars: the short-cycle shale we just discussed,
Right.
global LNG scale through assets like Gorgon and Wheatstone in Australia, and deepwater leverage from the Gulf of Mexico and, critically, Guyana.
But the quality of the actual barrels matters too, doesn't it?
It matters hugely. Market analysis highlights that Chevron's barrels deliver industry-leading profit margins. And just as importantly for the future, they have lower carbon intensity than many competitors.
And why is that so crucial?
Well, because low-intensity barrels are less likely to face restrictive regulatory export taxes or, punitive carbon border adjustments down the line. It protects their future access to premium markets.
And all of that operational strength is built on a financial foundation that gives them, what, exceptional M&A flexibility.
Exactly. The balance sheet is truly a fortress. Their net debt is at historically low levels. I mean, they barely use debt compared to their total capital base. This gives them significant flexibility for opportunistic acquisitions, or, as they prefer, increased share buybacks.
Okay, this is the structural differentiator we have to spend some time on, the truly unique geopolitical advantage they hold. Their optionality in Venezuela.
This is their crucial structural geopolitical edge. Chevron is the only U.S. oil major with an active special license from the U.S. government to operate in Venezuela.
The only one.
The only one.
Yeah.
They have 5 exploration and drilling projects there. This status positions them uniquely to supply Venezuelan crude if or when the regulatory environment begins to normalize.
It's fascinating to me that other major players have publicly called the country uninvestable, yet Chevron is actively present. They're engaged in operations. They're even in talks with the U.S. government to potentially broaden that export license.
And the competitive edge, it goes even deeper than just the operating license. It's about integration, the end-to-end supply chain.
What do you mean?
Chevron owns one of the most sophisticated refining systems on the U.S. Gulf Coast, specifically the Pascagoula refinery. This facility is configured to process the exact type of heavy, sour crude that comes out of Venezuela.
Okay, let's clarify that for the listener. What exactly is heavy sour crude, and why does that matter for the refinery?
Great question. Most easily accessible global oil is, light and sweet, low sulfur, flows easily, makes it cheap to process. Venezuelan crude is typically heavy and sour. It's thicker, almost like molasses, and has high sulfur content.
Which makes it complex to refine.
Very complex and expensive to refine unless you have a specialized facility. And Pascagoula is one of the few U.S. refineries that is specifically coked and upgraded to handle that heavy sour input efficiently.
So wait, if they can produce that specific heavy crude under a special license, and they own the specialized machine that maximizes the margin on that input, they create an immediate pricing advantage.
Precisely. Think of it like this. They own a highly specialized machine that only one supplier in the world, which is themselves, via the license, can feed efficiently. That provides immediate pricing power. Their competition has to buy more expensive, lighter barrels, or they have to pay a massive premium to upgrade their own facilities. That end-to-end integration creates a structural margin arbitrage that many of their peers simply lack.
Okay, let's pivot now from these deep, long-term structural drivers to what investors and traders are watching right now. The fundamentals look fantastic for 2026, but how does that translate into the immediate market action?
Right, we need to look at the immediate trading signals. Technical analysis shows that the shares recently closed around 155.90, near the high of a session, reflecting broader energy sector momentum.
And what are traders watching?
Technical traders are closely watching the pattern of higher lows into resistance near $156.
What does that suggest?
It suggests a constructive accumulation phase. Basically, buyers are stepping in earlier and earlier on any pullbacks.
It sounds like the stock is pressing up against a pretty clear ceiling. Is the momentum strong enough to break out?
The momentum indicators are certainly supportive. FED, which tracks trend movement and strength, is firmly positive. It confirms that this intermediate uptrend is robust.
But.
Well, however, if we look at the 14-day RSI, which is essentially the thermometer of trading activity, it measures how fast the price has moved. It is currently nearing 76.
And what does an RSI near 76 imply for the stock's immediate future?
It's considered overbought territory. This just means the stock has climbed very quickly in a short period of time.
So it might be due for a breather.
Exactly. While the underlying trend is strong, traders often expect a short-term consolidation or maybe a mild pullback, just to allow the stock to digest those recent gains before it can make a sustained vertical breakout past that 156 resistance level.
So not a sell signal, but maybe a signal to expect a pause.
Exactly, just a pause.
So we have a clear, strong uptrend, but maybe a slight pause is imminent. What are the immediate calendar catalysts the market is focused on right now, aside from just the daily oil price?
The next major near-term event is the Q4 earnings release. That's expected around late January.
And what's the focus there?
The focus during that call won't just be on production volume. The market will be laser-focused on updates regarding the Hess integration's synergy timeline. Are they hitting their targets?
Right.
And crucially, downstream refining margins.
Speaking of downstream, the analysis highlighted a potentially surprising point about that sector recently.
Yes, we saw U.S. refining profits spike massively. Increasing over 300% year over year in Q3 2024.
300%.
Due to significantly stronger product spreads. If that downstream strength, driven by gasoline and diesel demand, continued robustly into Q4, it could provide a significant near-term earnings surprise.
Which would mitigate pressure for maybe softer oil prices.
Precisely. Mitigating any minor pressure from softer year-over-year realized oil prices.
And beyond earnings, there's some serious geopolitical speculation buzzing around the company, isn't there?
There is. Some unconfirmed buzz suggests potential major M&A activity. There's speculation about a $22 billion co-led bid for Lukoil's overseas assets.
That's a big one.
It is. However, the more immediately impactful catalyst, if it's confirmed, would be positive news from those ongoing regulatory talks about expanding the Venezuelan export licenses. Any broadening of that license would be a substantial company-specific windfall.
Okay, we've built a very strong case for structural growth and financial resilience, but we have to provide a balanced view. Every investment has risks. What's the bear case here? What are the main pressure points?
The main pressure points, they really center on two factors: commodity price capping and geopolitical execution risk.
Okay.
First, while Chevron is designed to be profitable even at $50 Brent, that massive $12.5 billion FCF surge, it relies on mid-cycle prices. If stable to lower crude prices persist, particularly if they're sustained below $70 Brent for the next couple of years,
That'll cap the upside.
it will mechanically cap the full FCF expansion potential.
And the second risk is that highly lucrative but equally volatile Venezuelan optionality.
That's the major execution concern. Venezuela execution risk is undeniably high. We know the country's oil infrastructure is, and I'm quoting here, severely eroded after years of underinvestment.
Right.
Returning those fields to full production will take years and billions of dollars, and it will require sustained political stability. This carries inherent sovereign risk. You just can't ignore it.
So how does management mitigate that sovereign risk?
That's the key difference.
Hmm.
It's crucial to remember that the $12.5 billion FCF plan is fundamentally underpinned by diversified executable assets.
It's not all based on Venezuela.
Not at all. It's the Permian, the Tengiz ramp-up, the stable, Tier 1 Guyanese assets from Hess. Venezuela is truly just upside optionality. The core growth story is happening regardless of political stability in Caracas. They are not dependent on Venezuela for the success of that 2026 target.
So what does this all mean for you? It seems like Chevron offers a powerful total return thesis. You have a fortress balance sheet, disciplined reinvestment with CapEx capped for resilience, and a visible, almost guaranteed $12.5 billion FCF uplift by 2026.
And it's coming from a collection of globally diversified, high-margin assets.
Yeah.
The combination of that predictable structural organic growth and that unique geopolitical optionality makes this a really compelling story, especially for long-term investors.
So what's the right time horizon?
To capture the full ramp-up of the FCF drivers, Tengiz, Hess, the Permian, a multi-year hold, probably 2 to 4 years, is the appropriate investment horizon.
That structural advantage in refining is the final provocative thought we want to leave you with. Given that U.S. refining profits shot up over 300% year over year in Q3 2024, showing just how powerful those product margins can be, how much more integrated value can Chevron truly unlock by strategically connecting its uniquely licensed Venezuelan heavy crude to its specialized U.S. Gulf Coast refineries? That is the arbitrage opportunity to watch and to measure over the next cycle.
That potential margin capture, that is the true differentiating factor. It's what sets them apart from the other majors and will define their cash generation in the coming years.
That's the lowdown on Chevron for today. We'll catch you on the next one.